Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
Hello, welcome to Pilot Money Guys. I'm your host, Charlie Mattingly. Today I have Chief Investment Officer, Chartered Financial Analyst, Charter Holder? Is that how we say that?
Yeah.
Andy Christopher.
Great.
Andy Christopher, thanks again for being with us. Andy, we appreciate it. The Pilot Money Guys, we're here to educate, demystify, simplify, any other words I can rhyme with, but just kind of help people in plain English.
Sure.
What's relevant to them, what can be helpful to them. Sometimes we got some hard-hitting steps to follow, but sometimes it's just for information and mindset. I love the mindset. I love just kind of helping people with the ways to think about markets. And I think that's what today is going to be like, is just reviewing the market lessons we learned from last year, reviewing that. Super helpful. I love to do that every year. My favorite, Andy, is the behavioral finance part of it, the behavioral component. And I know you know that stuff as well, but you're also very good with the nuts and bolts. We want to help our pilot audience with those things as well today.
Yeah, that sounds great.
Excellent. Sounds great. So, we appreciate our pilot audience. Please share the podcast with someone that you might think it could help. We appreciate all your rating and reviews as well. Those really help us to reach more people and help more people. So that's what we love to do. So thank you for doing that. And also, we still have the Pilot Wealth Index on there. If you want to know if you're reasonably on track, thinking about the right things, take the Pilot Wealth Index. We respond to every single one of them, Andy. So we kind of let people know, hey, that looks good. What about this? What about that? Or whatever. If they have any questions, check it out. Also, you can reach me and you directly, Andrew at leadingedgeplanning.com or Charlie at leadingedgeplanning.com. So please reach out, and we're excited about that. So let's get started, Andy. You've kind of done the outline for us for the market review, quarterly market review, you're calling it, from last year, but it's really kind of a big picture of last year as a whole as well.
Yeah.
So
I said quarterly, and then I didn't talk about the quarter at all. We just did the year.
We're supposed to have a quarterly review. That's probably why.
That's probably right. Probably right. Yeah. But it's the end of the year. It's the right time. Talk about how the markets did, what happened in the markets. And you're right, Charlie. It's not, in no way is this meant to be forward looking into what might happen. We never know. It's just a good opportunity to, I think, learn about the markets and just learn why were things the way they were. So it's just, I think it's more interesting than it is instructive for how you should manage your portfolio.
Yeah, absolutely. So what's this year going to do? Give me some numbers.
We just talked about this, Charlie.
Anyway, but no, I love it. To me, it's like a debrief. As much as we all hated debriefs after flying in the Navy/Air Force, it's a great debrief to look back and help us to learn, going forward as much as we can from the past. Because like you said, some of us don't have a crystal ball. I know you do. You're going to tell us today the returns and all that kind of stuff.
That's right.
That's a joke. I've got to disclaim for the SEC. That's not true. But anyway, we are going to have what we think would be some good lessons learned. But Andy, let's start off with just kind of your big picture thoughts. This time last year, what were you thinking about, or looking back, however you want to frame it, big picture wise?
Yeah.
What do you think?
Yeah, I think this time last year feels a lot like this time this year, which is, wow, the markets are doing really well. Surely we can't have another good year in the markets. So that's the big one. And I think we can talk about that and maybe how to think about that. Now, I would say for our listeners, this might be a good YouTube podcast because we're going to share the screens a little bit. But that's the big one, right? S&P 500 was up, I think, 17.8%. That's not normal. And it's consistently performed that way. So I think that to me is like, man, can this keep going on? And I think that's a question that a lot of people have that we should dive into. And I think the one that maybe surprised us, Charlie, a little bit was international. International had a really, really fantastic year in the markets. International developed was up almost 32%, 33.5% on emerging markets.
Wow.
And so I don't know that we were expecting that per se as we rounded the corner.
Sorry to interrupt you, Andy, but if you feel like sharing that slide that has all of those, like you said, this is going to be a good one to watch on YouTube. We will have it posted on YouTube. because the visuals to me, when we start spouting off numbers, boy, I get lost really quickly.
Yes.
But I remember, Andy, this time last year, I said to Kevin, I think you were on the boat already, weren't you? Were you on the boat already?
Maybe.
Yeah.
Yeah, I was. Yeah. Yeah.
So did a little deployment last year. But anyway, I remember just telling Kevin, I've had it with international. I can't stand it anymore. I'm about to give up. And I was joking, of course, but that's what it feels like when you're diversified. This time last year, the question was, why would we invest in anything else besides the S&P? It's nobody's beat the S&P, and on and on and on. And man, the markets make you feel stupid sometimes. I'll just say it because I was like, well,
Yeah.
we know we're supposed to diversify. Thank the Lord, international emerging finally showed up because it's been difficult lately. If you're truly diversified, Andy, what do you think?
100%. Yeah, 100%. I mean, I think diversification really is, you're never going to have the number one performing stock and asset class. That's just part of it. But really, diversification is a risk mitigation. And then you just don't know when you're going to capture some of these other areas of the market and when they show up, right? So you just kind of want to own all of it, right? Is kind of the way I think about it.
Yeah. I wouldn't be surprised to start seeing, I don't know if we'll see them now. Maybe there was a few I saw last year about how wonderful international is or was, or people think it will be. Clearly that, again, the past doesn't mean a whole lot, but nonetheless, this is about when people start piling into those higher performing asset classes. And unfortunately, if you weren't diversified before, now you're buying high to a certain extent. So that's where the investor behavior comes in for not diversified.
Absolutely. Yeah, I think if you're someone you had a moderate portfolio and you said, man, I really think this is the time now. I want to, go 100% into whatever the most recent highest performing asset class is. That would be a pause type of moment for me as an investor of like, what am I really trying to accomplish here with my investments? So to me, that's kind of how I think about it. I'll just say, I'll get a little technical, but, we think about where the markets are right now. And one measure of valuation, right, would be like the price to earnings ratio. So right here. So in other words, right, S&P 500 is 22 times its earnings, meaning you have to pay $22 for every $1 of earnings. The historical average is 17%. And so this is a great chart for those of you who are listening. Basically, it says on what is the forward P ratio and subsequent 5-year annualized returns. And the chart would suggest, right? The chart would suggest that returns in the next 5 years in the S&P 500 at least are going to be fairly low. So this is my favorite thing. I get to talk out of both sides of my mouth always whenever you talk about investments. But the problem is I've been showing this chart for almost 6 years now, since like 2019. And it's been literally in the same exact spot the whole time. And so that's the point of, you just don't know where these things are going to come from. It's hard to say. And maybe this is the opposite of what you're saying, Charlie. If someone said, "Man, we're at all-time highs. How can we do any better?" That you don't know. There'll be a correction. You just don't know. You don't know when. One of the things I do like to think about is like, well, how has the market performed after all-time highs? This is from Dimensional, but from 1926 to 2024. 1 year after all-time highs, annualized return is 13. On a 3-year, 10%. So and 5-year on about a little over 10% on both those. To me, that suggests that the market, even at all-time highs, continues to do well. It continues to provide good returns. And I think in some sense that kind of makes sense, right? We're in an economy that's growing, right? We have a positive GDP. We're becoming more productive, talk about AI. And so there are these tailwinds to a market that just allow us to continue to grow and continue to have capital invested where it needs to be allocated.
Yeah. I like how you kind of mentioned, I think you said talking out of both sides of your mouth or maybe something like that. But when there's a market high, what you and I are used to seeing is two schools of thought. Like, man, this is great. It's going to keep on going. Clearly, it's going to keep on going. It's up.
Yeah.
So it'll continue up. And that's another behavioral bias that we all have. It's called recency bias, where we take the most recent piece of information and give it too much credibility, essentially. We forget the other 90 years of data that says something a little different. But that's okay. The other part of that is, well, hey, the market's at an all-time high, so therefore it's going to crash. Really, neither one of those. We got to be careful about leaning into either one of those. And you just showed the data that says, hey, neither are true, essentially. So
Yeah.
be ready for anything.
Yeah, absolutely. And I think it's important to note, again, this is the other side of the mouth is 17% last year. The average return, annualized return, I shouldn't say average, the annualized return since 1926 through 2024 is like 10%. And
Mm-hmm.
so you have to either believe, if you think you're going to get 17% every year, you have to believe there's structurally something different
Mm-hmm.
in the market. And
Yeah.
so maybe that's not true. So there you go. There we just did it. We came full circle. We talked out of both sides. Said the market always does great when you're at all-time highs.
Yeah.
And oh, by the way, we've done really well. And there's
Yeah.
a mean reversion is a thing. That's
Yeah.
yeah.
Well, you and I like to prepare. Again, we've got a pilot audience, so our pilots are always prepared for any scenario, bad weather, whatever it might be that come up and surprise somebody. But it's
Yeah.
really hard when the market's been doing so well for so long. We get a little complacent, we get a little bit lazy, and the as investors, I mean, and I think the tendency is to take more risk. Oh, markets are doing great.
Yeah.
Like I said, that first statement is like, well, how do we know they're doing great? They did great yesterday. But anyway,
Yeah.
it's alluring, and people will take more risk. They'll buy a little more speculative things, and then the market punches you right in the face. You know what I mean? With
Sure.
with a
Yeah.
downturn that we just out of nowhere. So we're always ready for that scenario because we
Yeah.
just don't know when that's going to happen.
And we felt it a little bit in 2025. We had, the March, April,
Mm-hmm.
tariff, I don't know, meltdown, if you will. And so it wasn't a given that 2025 was a good year. You just share, this is a good slide. It shows kind of what happened in the market, right? In April, you didn't think you were going to get 17.8% in the S&P 500.
Yeah.
You just didn't know where this was going to go. And that's, if you remember, that's when the administration essentially really implemented some pretty aggressive tariffs. And of course, that changes the dynamics from an economics standpoint. So that gut punch, if you will, Charlie,
Yeah.
that you mentioned, like we kind of had that throughout the year. And if that caused you to want to do something different, maybe reflect on that and think about how you handle that to kind of allow your portfolio to weather any market condition.
Yeah. The markets and what happens in the economy or even the political environment like last year continue to surprise us because, tariffs have gone up before. That's not a new thing.
Yeah.
And you did a great job in your when you wrote about the review last year, the Q4 report. You talked about, hey, there's some things that normally happen when tariffs go up, and they didn't. None of that happened. In fact, I think the opposite may have happened. But can you elaborate on that a little bit?
Yeah, I think, tariffs really, three things should kind of happen, right? One is we expect if there's tariffs, like tariffs are really just a tax. They're just, right? Someone has to pay for that, whether that be the exporter or the importer or the end user. But at the end of the day, someone has less money, and in a market where it's a zero-sum game, like someone has less money, right?
Mm-hmm.
And I guess the government is the one exception of that. They get more money. So you would think, right, like the market would react negatively to that because a company is going to have less money, or if you pass on to your consumers, they're going to have less discretionary income, and that's going to flow through into the price of the asset because it's just a reflection of future cash flows. Cash flows are lower. Well, we just talked about how that's not what happened anywhere in the globe, right? Anywhere internationally, markets did great. The dollar should actually appreciate, and that makes sense. That should compensate importers for that extra tax, if you will. And then you would think inflation should actually maybe go up, because if we're in an environment where if we're adding a tax on, that means things are costing more. What we know is if we've experienced this recently, if prices go up, that's inflation.
Mm-hmm.
And so that, the dollar did not appreciate. The dollar actually depreciated about 9%. That helped you as an international investor, by the way. And inflation, was modestly elevated around 3%. The Federal Reserve target is 2%. So I think if you were somebody in January, a new administration coming in, and you were like, I got this, I know exactly what's going to happen, that may not, you would have been surprised.
Yeah, absolutely. It is amazing. And this is why I love these lessons learned, because even when we think, hey, these things are happening and therefore this will happen, that doesn't pan out always. And I remember during that time, of course, you were on your boat sipping Mai Tais or whatever you Navy guys do. And me and Kevin were holding down the fort. I remember somebody going, hey, I bet the international markets are getting hammered right now because of all these tariffs. And I was like, well, you might think that, but in fact, they're not. They've doubled up. In fact, by the end of the year, they doubled up on the
Yeah.
S&P. It's pretty incredible. So I think that is a lesson learned for me. Again, is just be very humble about trying to anticipate market directions based off of events, news
Yeah.
headlines. One more story to illustrate, and that is, it was a spring of 20. When was the Ukraine? I think it was 22, right? Russia, Ukraine.
2022. Yeah.
22. Yeah, I
Yeah.
remember.
February of 22.
February, yeah, absolutely. Because I was on a mission trip in Africa in a tent, and somebody called me somewhere. So anyway, it was interesting because one person said, "Hey, we should go to bonds." And I was like, "Okay." We talked about the pros and cons, of course, and if something bad happens, usually there's a flight to safety to bonds, right? And so we did add some, but boy, that was a bad decision. And looking back in 2022, because that was the worst year ever for some different types of bonds. But
Yeah.
I think, again, the lesson here is that don't try to anticipate. You have to diversify. You have to be prepared for multiple scenarios. Anytime we start to think we know what's going to happen, we better check our humility there, because the economies are so complex. It's just mind-boggling.
It's a great point of, we as investors, I think, want to distill the market movements into one thing, right? Like, what was the one thing that caused the market to go up? And it's not one thing. Like, there are millions and millions and millions of reasons why people trade every day, right? Like, if you need money out of the market, you're not making an assessment on how the market is going to do. You just like, I just need some money, and so I'm going to go sell some things, right? Like, that's a trade, but that's an inject into the market. And so it's the accumulation of all of those things that are happening. So it's never just one thing; it's all of the things.
Oh, yeah. And you're dealing with human behavior in
Yeah.
those things, which is extremely unpredictable. And again, that's why we love it. There's the art and the science to it. But Andy, I want to ask you about market highs. We talked about that a little bit. This
Yeah.
is a trick question. How many market highs did we have last year?
Oh man, let's see.
I actually looked.
Did you count them?
No, I didn't. I couldn't. It was too many. There was too many.
There were
too
many. I've got it here. Yeah. I'm not going to count, for the sake of our audience. I'm not going to count them right now. I'll just show you them. And here we go. So
and I knew you didn't know that answer because I didn't know it either. And I looked and we have this diagram, but this diagram is powerful for those that are on YouTube, because it looks like, from late mid-June or mid-late June on, we had a new high like all the time. And that makes sense.
Yeah.
And like you wrote about, we've talked about before, that's not abnormal.
Yeah.
What do you have to add to that?
No, that's exactly right. Not abnormal at all. Again, that is a byproduct of a strong economy, or an economy that's well functioning.
Yeah, absolutely. What we talk about a lot of times is our human behavioral reaction to market highs, and again, some people will go, yeah, it's going to continue to go up. Some people go, well, the bubble's going to burst somehow. And I'll have you talk about maybe that in a minute if you think there are any. But there is a game out there I wanted to share, and maybe we'll put in show notes. It is it's basically the S&P 500 market timing game. So Google that, and you'll find one. It's titled engaging-data.com. But if you Google the market S&P 500 timing game. But anyway, I did it, and I'll go in there and I'll play around with that every once in a while. It's kind of fun. And every once in a while, one out of about 100, you might win. You might beat the S&P. Like it's interesting because you just go sell, buy, and you can see it going up and down and all that stuff. But it's interesting because you don't beat it. When you do beat it, it's like negligible. It's almost negligible. And secondly, it's extremely stressful. I'm like today, I think I beat it by like a couple $100, and I was like, my heart was pounding, my palms were sweaty. I was like, no thanks. That's really stressful.
Yeah, I love that game. I never use it in client meetings. I'm too afraid like the client's going to crush it, and I'm like, well, I don't know where to go from here. Like, I'm stuck.
It is. That happens every once in a while.
Yeah.
And let's say you do beat it, man. Is it worth the stress? I got to give an analogy, Andy, because it reminds me of when I'm taking my kids to school or something. Man, here comes this motorcycle, and flying through traffic, zipping in between lanes in front of everybody. And I laugh. I'm an old guy now. I just laugh. Hey, I'll meet you at the red light. We'll be there at the same time. But every once in a while, they get through that red light and they actually arrive on way earlier than I do, right? So they won that game,
There you
but
go.
they almost died. You know what I mean?
Yeah.
So
Yeah.
I'm like, well, so that's my analogy for the day, Andy, because every time I see it,
Appropriate.
I think about investing.
Yeah.
Yeah,
Yeah. Don't come to California. The lane splits.
yeah,
It's crazy.
stressful. But Andy, it's time for our commercial break.
All right.
Are you ready for that?
Let's do it. More
This
Ovaltine.
podcast is brought to you by Leading Edge Financial Planning, and sometimes people think that we just do podcasts. We're just the Pilot Money guys, but you and I are both lead advisors at Leading Edge Financial Planning, and we serve our clients. And so, if you feel like you could value from some of the things that we talk about, then give us a call. We'll have a free consultation. Just discuss, we love to discuss what our prospective clients are dealing with, what their goals are, what their expectations, some concerns they have, just decide if we're a good fit, we can add value, then we go from there. But just want to take a pause for our commercial break real quick. And now Andy, back to the regularly scheduled podcast. What's
Excellent.
next on your agenda as far as the review?
Yeah, I know we've talked about it. Maybe international. That's a good place to maybe to dive in a little bit as well. And I think just kind of what countries did really well, right? We already talked about S&P 500 here. And then you can see 2025, right? You got to talk in US dollars or local. And again, if you have a depreciating dollar, that's actually a tailwind. That's what that helps you, because you get, if you have Sony stock in Japan, and that's actually maybe not a great example, or UK, right? What's a good UK company? BP?
Land Rover.
Okay, there you go. Land Rover. If the dollar depreciates, that means that those dollars that company is in British pounds, and then you actually get more dollars when you convert it over. So that's kind of how that interaction works. But these are companies that 35%, France 29, Canada 37, not bad. Taiwan, so just they've done really well. And I think kind of like, well, what's changed to do that? One is in Europe, right? And you talked about earlier, was NATO, Ukraine, all right. And so you can see like European aerospace and defense, they're getting, I think, much more serious about spending on their defense. And there's been all sorts of GDP targets. Taiwan, I think that kind of, Taiwan semiconductors, right? So that all kind of rolls into there. But, those are kind of some really big drivers of international returns. Japan has new leadership. Japan has had like very low interest rates, and now they have the expansionary monetary policy and fiscal policy with new leadership. So you can see like that has really done well over the last several years. So there's just some things that are changing in the global equity market that I think are providing some tailwinds, if you will.
Yeah, absolutely. Andy, that may be a good transition, unless you have something else on that, then interject.
Yeah.
But I know you and I want to talk about the Fed setting interest rates, a little bit of just background on that. But anything else on some of the trends before we move on to that?
No, I think that's great.
Yeah, because
Great
it is
discussion.
fascinating. It's fascinating what happens, and especially this year with the tariffs, like you said, increasing, essentially being inflationary. That's just the way it is. And then the Fed sometimes fighting against, in this case, I don't think that would be officially fiscal policy, but the government has fiscal policy and the Fed has monetary policy. And sometimes it seems like to me, Andy, they kind of go against each other or offset each other maybe. But you don't have to comment directly on that. But what are your thoughts on the Fed's impact?
Yeah. I mean, it's central banking in general, I find fascinating, and it's an interesting topic. If you think about what is the Fed's job, right? They have kind of a dual mandate. One is price stability, so that would be inflation, all right? So we don't want highly inflationary environments. That's not a very stable price. Or deflationary, prices going down, and maximum employment. And so those are the two things they're doing. That's like I said, their dual mandate. And how do they influence that? Well, they can adjust the interest rates, especially on the short term, And that essentially adjusts the supply of money in the market, right? So if we are in an environment where we're in a slowdown, we think hiring is slowed down, then that would be a time to increase the supply of money in the market. So that would be, we want to make it easier for companies to lend, or for banks to lend, and companies to go out and expand and buy the new products and capital expenditures. Or conversely, right, we're in a highly inflation environment. We saw this a few years ago. And inflation is like 9%. Like, we got to slow this down. How do we do that? We increase interest rates in order to reduce the supply of money in the market, so that we are, I'd say, there's the Federal Reserve. I think, I forget which chairman of the Federal Reserve said it, right? But their job is to take the punch bowl away just before the party gets out of hand. So that's kind of the William McKinsey Bryan. I don't know which one it was. So that, maybe a little bit of backstory. Maybe we can dive, I think it's really fascinating just how was that decision made, right?
Yeah. Hey, Andy, let me rephrase what you said, though, because to me, it's fascinating in that people go, yeah, lower rates, lower rates, lower rates. I'm like, well, if the Fed's lowering rates, that means economic activity is slowing down. Yeah. And they're trying to prime the pump, and so I'm like, it's a little bit of a mixed blessing because, well, the markets love, first of all, it's like a sugar high. The markets seem to like in the short term, they seem to like lower rates. And you and I might like lower rates because we can go maybe refinance our home or something. Maybe you could talk to that in a minute. Talk to the relationship between short and long term, or mortgage rates. But it's a mixed blessing. If the Fed's like, yeah, we got to lower rates, I'm a little bit alarmed. Go, okay, well, what's slowing? Is the job market not as healthy? Are we heading into a recession? Yeah. And so those are things that I think about. So it's a little bit of a mixed bag there when they do lower rates, because again, like you said, when they raise rates, they're discouraging lending, which slows down economic activity because there's too much of it. But anyway, anything to add to that, Andy?
No, and right now we're in kind of an interesting situation where inflation's actually a little bit elevated. There's some concern that it could continue to go up, especially if you start lowering interest rates. But the hiring market has slowed down dramatically. There's for lots of reasons, and so I think that's where the Fed is feeling this tension on the monetary policy side of how do we make sure we don't let inflation get out of control, but at the same time keep companies moving so they continue to hire. And keep our employment rate at a reasonable level.
Yeah, absolutely. And the Fed is amazing. We could have, in fact, we did have a whole podcast on. We had someone at the Fed here.
That's right.
I'm looking at my notes real quick. The Fed,
a few years ago. Yeah.
It was Flight 88. There we go. We had one of the public relations from the St. Louis Fed on. I thought it was fascinating. Of course, I got to talk to her a little bit before and after the show podcast as well. And I would encourage people to check that out just to hear her perspective.
Yeah.
But I think one of the things that's interesting is the Fed lowering rates. Again, short term, kind of nice. We want to, maybe it increases economic activity. The stock market might get a little bit of a sugar high, but it doesn't necessarily mean that longer term rates are coming down. It's not all encompassing. That there are many rates out there.
That's right. Yeah. So I think that's a great point. You talk about refinancing your mortgage, right? And I know the current administration, the president, that's a big goal of his, is to have lower interest rates, because that would encourage lower mortgage rates, which would make it, of course, easier to purchase a home. But those rates are generally based on the 10-year Treasury rate, right? And I think it's important to note that a Treasury bond, note, bill is no different than any other investment. It's no different. It's still subject to the laws of supply and demand, and you still need buyers, and the buyers will set the appropriate interest rate. In other words, if there's concern about lots more supply, right, in the market, because the government has to issue more bonds to pay for interest, to pay for fiscal deficits, they're going to demand a higher rate. The Federal Reserve doesn't have the ability to influence that. And that's going to come from institutional investors. It's going to come from reserve banks overseas, because the U.S. dollar is the reserve currency for the majority of the globe. And so I think it's important to note that you could see rate cutting, and at the same time, right, on the short end from the Federal Reserve, at the same time see rates go up on the mid to long term, the 10, 20, and 30 year. because there's more, again, back to like what's at play here. It's not just one thing. There's market dynamics at play that are outside of maybe the scope of the Federal Reserve and central banking in general.
My number may be wrong, Andy, but it still, I think it's going to be in the ballpark, and it proves the point that I think I heard somebody say one time, the Fed rates, the ones that they impact or have control over, like you said, short-term rates, they only impact about a third of the overall interest rate environment. So again, not sure that that number is exact, but I think it just proves the point that you're talking about. Supply and demand is and that's the beauty of a capitalist economy, is that supply and demand dictates a lot of those things instead of a government agency or pseudo government agency or whatever.
Yeah. Absolutely. Yeah. 2026 will be an interesting year for the Federal Reserve. I wrote, this was 2 weeks ago, about drama. And of course, today we've got some drama, right?
Yeah.
With the Reserve, for those who've been following, of course, by the time this podcast comes out, who knows? But the investigation, I suppose, is a way to say that, into the Federal Reserve Chair, Jerome Powell, and the remodeling of the Federal Reserve building. So we'll see where that goes.
Yeah, always interesting when it comes to political environment and the Fed and all those things. But let me think. What I was looking at in the Fed and your notes that you wrote about, and you talked about the Federal Open Market Committee.
Yeah,
and I'll have you talk to that a little bit. But I remember back in the day, there was QE. Remember quantitative easing? I think it was after. I think it went on for a long time after 2008 because they were trying to prime that pump, lower rates.
That's right.
Interest rates were zero for a long time, I think. And so I remember talking to somebody one time. They were like, "Oh, can you believe the Fed is, doing the quantitative easing, which is essentially selling or selling the bonds, I think, or I get those buying the bonds. Thank you, buying the bonds."
Right. Yeah.
And so that's the way to drive interest rates down. But I'm like, well, that happens all the time. Federal Open Market Committee operates all the time, is always buying and selling bonds, right?
That's right. Yeah, that's how they do it. And you can see here, we were in a zero interest rate environment from essentially 2008. We saw 2014, 15. And then, of course, COVID put us back into that. And then this was the big inflationary period in 2023 and 2022, 2023, where rates are now kind of 5%. And then we can see we've been in a downward trend. So I think, to your point, right, it's, what is the Federal Open Market Committee, right? Like, who decides? Because I think we all look at Jay Powell, he's the Fed chair, and we say, well, does Jay Powell just get into a room once a month and decide here are interest rates? And it's actually, as you can expect, it's a little bit more nuanced than that. So you do have this, what's called the Federal Open Market Committee, or FOMC. And it's pretty interesting, right? It's obviously chaired by Jay Powell, but we have governors, or what's called Board of Governors, and they are presidentially appointed. There's 7 of them. And they're always on the FOMC. They're always on the committee that vote on rates. And then we have bank presidents. So if you didn't know, there's 12 Federal Reserve regions, right? You talk about St. Louis, that's Region 8. I happen to be in Region 12, where San Francisco, I live in San Diego, but San Francisco is the bank. Charlie, I think you're in the Atlanta Federal Reserve District. And so, but they have bank presidents, right? And so they're, the way to think about that is they're really chosen by bank leaders, and, there's a complicated voting process and decision process, but they have bank presidents. And so 4 of those bank presidents then sit on the FOMC on a 1-year rotating basis. The Federal Reserve Bank President of New York is special. He or she always gets to be on the FOMC because that's kind of the center node of finance and, in our economy. And so that group, those 12, they're the ones who get to decide on what is the direction of interest rates. We could have a whole podcast on dot plots and, what comes out of those. Yes. I love a good dot plot, Charlie. I don't miss it. They come out and they say, here's where we think interest rates are going to go. Yeah. So Jay Powell, the Fed chair, of course, his term expires this year. He actually has 2 more years as a governor. Remains to be seen if he stays on. But he has to build consensus for these interest rate setting environments. Of course, President Trump he's appointed Miriam as a governor, right? Presidentially appointed. So there's a lot of different factors at play there.
Yeah, absolutely. Yeah, it is interesting, and I know it gets political too, and people get very passionate when they talk about the Fed and things. But I'll just say this, and people are going to say you're stupid, you're naive. But after talking to and doing the podcast with the person, man, I just got a sense that they wanted to do the right thing. They wanted to fight for their independence. It was very important that they stayed apolitical for a lot of really good reasons. And by the way, they have more PhDs than like any other business in the world working at the Fed. So they're some pretty intelligent folks. So I think they have good intent, whether it's always executed perfectly or not. Well, that's another story because it's really, really hard.
Yes.
So anyway, that's my disclaimer. People are going to write me maybe some hate mail or something like that, but I think that's my opinion. But Andy, as we wrap up today, and feel free to tack on any Fed things that we may have missed or you wanted to address, but we're going to talk about a little bit of recap, lessons learned, if you will, from each of us. But anything on the Fed or Federal Open Market Committee, we could talk on that for a long time.
Yeah, we could. No, I think that's a good spot.
Yeah, absolutely. By the way, when interest rates went up, but like we had an environment recently, the market doesn't necessarily the market's going to go down. So,
that's right.
But anyway, for whatever that's worth, as I was looking back and reviewing the last year's stock market, a couple of things came to my mind, and one was every one of us need to have a plan. Whether that be a written plan for investing, a written plan for my retirement savings, preparing for that. Maybe you write it down on a piece of paper, maybe you take some notes in your phone or whatever. But I think the more intentionality you have there, the more thought you put into that plan, the better. Because it's going to help you to avoid being distracted by this short term, which is sometimes noise. And sometimes it's really hard to know what's noise and what's not. But I think you just got to invest. As you get older, you got to invest some time into an investment game plan, into a retirement game plan. Last year, the market did really well. A lot of people's portfolios, depending on how much money they have and what phase of life they're in, produced an extraordinary amount of income for them, or capital gain that year, which to me says, hey, this is very serious. And you need to be thoughtful about it. Obviously, we're in that business, and so we're a little biased, but I think most people would agree. Most professional athletes or anybody that's at a high level has coaches, and they think about and are intentional. The corollary to that, Andy, is to turn off the news. Read the news. You know what I mean? If you like news, just read it because it takes the emotion out of it. And sometimes the news would have us believe things are more important than they are. There you go.
Still comes every day.
That's
Wall Street
right.
Journal.
Absolutely. So read it. It takes the emotion out of it. It keeps you informed, and it's just really hard to discern sometimes what's important news, what's relevant to you. So I think if you turn it off in general, tune out the noise, you'll probably be happier. Which leads me to my third point, which I revisit every time I do a podcast. I just relearn and re-listen and relearn, and that is to practice gratitude. Because sometimes when, like last year in April, when things get crazy, things get uncertain, we get anxious, we get stressed out, people, it's stressful. It's hard to think about sometimes those things, but gratitude is free medicine for stress, anxiety, anything. It's just amazing to me the more I study and read how powerful practicing, and I say practicing because it's a manual override. It does not come naturally for anyone. We're not wired that way, and that's just the way it is. So, Andy, those are my three. What about you?
I don't know that I have three. I think kind of back to your point of everyone should have a financial plan. I think, and within that plan is have an understanding of what market returns do you think you need to be successful, not predicting the market, but thinking about what is it? And I guarantee you it's not a 200% return. Right, it's probably like maybe 10%, right? If you're in a 100% stock portfolio, and how much time do you have to weather that storm? And I bring that up because if you want to get out of the business of trying to hit home runs for the sake of home runs, right? That doesn't do you any good from a financial planning, investment planning perspective. So I think that is a way to frame the discussion of like, I've got a plan that I want to get 10% every year. Right. Well, you're not going to get 10% every year, but on average or a moderate level of return, I think that keeps you from really going aggressive, maybe as an investment approach. The other one that struck out to me we haven't talked about is just commodities, silver and gold. Silver was up 158%. Gold was a slacker last year, only up 67%.
Oh my goodness! Wow.
And that's great. And there's lots of debates on whether that should be a part of your portfolio. But if you have it, I think if you have any asset class that has gone up 158%, ask yourself, like, is now a time to rebalance, take some chips off the table, and maybe why you hold it, right? What are you afraid of when you buy gold, silver? Is it inflation? Are you afraid of inflation, dollar? And I just think like that would maybe help because there's products out there like TIPS, Treasury Inflation Protected Securities that are bonds. They're much less volatile, and maybe that is a good replacement security for gold, depending upon why you elect to hold it.
Yeah. And I only hit the Jim Cramer sell button there. You heard it sell, sell, sell because it's so high. You know what I mean? That's the, like you said, take some chips off the table, possibly, and kind of being facetious a little bit, but it's so ingrained in us that if it's high, that equals good and we should buy more.
Yeah.
When that's not really a disciplined plan. That's a bad behavioral plan that says buy high and sell low, which is bad for your returns. So anyway, I'm being a little bit facetious on the gold and silver, but it is also, silver especially, is very volatile. So we know that. We've seen that in the past. But awesome, Andy. We'll anything else for us today?
No, enjoyed it.
All right. I think the big picture here is just stay disciplined, have a plan. Hopefully today was helpful. Again, reach out to us anytime if you have questions, things you'd like us to cover. We appreciate your reviews and ratings. Again, it helps us to reach more people. So thanks again to our pilot tribe, our pilot audience for tuning in today. We look forward to seeing you out on the road at some of the conferences we go to, and we love hearing from all of you. So we appreciate it. See you next time.
All right.
Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out. Give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie at leadingedgeplanning.com. Again, that's Charlie at leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.